The global economy once ran on a paradox first noticed in 1971 when the United States severed the dollar's tie to gold, unleashing a new age of floating currencies and unchecked credit expansion. This moment marked a contradiction. Central bankers promised stability while embedding deeper systemic risks into the world's financial plumbing. Credit cycles behave like seasons, expanding into summer booms before freezing into winter busts. And economic history shows these cycles are both predictable and relentless. Borrowing shifts wealth forward in time. But when debts surpass sustainable income, the system strains and cracks begin to show. Across the 19th century, sovereign debt frequently provoked defaults, with nations like Spain and Greece repeatedly renegotiating or abandoning bonds. Governments learned that borrowing to fund war and infrastructure could lead to cascading defaults when revenues failed to keep pace with interest. In 1929, excessive credit fueled stock market speculation and pushed valuations far beyond earnings, setting the stage for the Great Depression. When the Federal Reserve tightened monetary policy, credit contracted, banks failed, and unemployment surged above 25% by 1933. Post-World War II soon followed into reconstruction was financed through rebuilding credit systems under the Bretton Woods framework, but this stability was contingent on disciplined monetary policy and controlled government borrowing. When that discipline evaporated in the late 20th century, the world's financial system accrued risks that remained invisible to most investors. Inflation is not a theory, but a historical phenomenon, seen in hyperinflations like Weimar Germany in 1923, where monthly prices doubled while savings evaporated. That episode was rooted in war reparations, massive money printing, and political instability that collapsed the value of the mark. In Argentina, decades of chronic deficits and monetary financing produced repeated currency crises, most notably in 1989, when inflation surged past 5,000%. Argentinians learned that unanchored currencies can destroy purchasing power and undermine economic life. When China shifted toward market reforms in 1978, it tapped credit markets to finance growth, setting records in industrial output and infrastructure spending. Sustained borrowing, however, has left China with one of the largest credit-to-GDP ratios among major economies, intense real estate sector stress, and looming defaults among local governments. Sovereign debt is a promise of future wealth. When that promise is overissued, creditors and citizens both bear the cost. This fundamental economic constraint underlies every major debt crisis in documented history. Wall Street firms in the 1980s expanded credit aggressively through junk bonds, pushing leverage into corporations that could not sustain debt payments. When several high-profile defaults hit, the market reeled and regulators edged toward reform. In 1997, the Asian financial crisis spread from Thailand to Indonesia, South Korea, and beyond, revealing the dangers of short-term dollar borrowing by emerging economies. Capital flight forced currency devaluations of 50% or more, causing recessions and IMF bailouts that conditioned structural reforms on hard fiscal discipline. Japan's lost decade began in 1991, after an asset bubble inflated by easy credit and speculative land prices finally burst. The Nikkei plunged nearly 80% from peak to trough, banking losses mounted, and deflation became entrenched. The 2008 global financial crisis was rooted in the expansion of mortgage credit, securitization of risky loans, and the illusion of diversification through complex derivatives. When housing prices fell, losses cascaded through the banking system, forcing governments to inject trillions in bailouts. Central banks responded to 2008 by slashing interest rates toward zero and later engaging in unprecedented quantitative easing, expanding balance sheets enormously. These policies stabilized markets, but also seeded future vulnerabilities by compressing risk premiums and encouraging leverage in new forms. Debt is a sword that cuts both ways. Borrowed funds can build productive capacity, but excess borrowing creates fragility that amplifies downturns. When debts dominate economic growth, servicing those debts diverts resources from investment into maintenance. For ultra-wealthy investors, financial collapses are not mysteries but patterns to study, like seismologists tracking fault lines before an earthquake. Their strategies, rooted in risk management and optionality, reveal how capital reshapes itself in anticipation of system stress. Billionaires often increase exposure to hard assets such as gold, real estate, and commodities during looming systemic instability. These assets provide a hedge against currency debasement and ultra-low interest rates that erode financial returns. They also allocate to alternative credit funds that profit from distress, effectively betting on widening credit spreads when lenders demand higher compensation for risk. These strategic positions have delivered outsized returns in past credit cycles, including the 2008 credit crunch. Historical monetary policy failures show that loose credit expands until inflation becomes visible and then tightens only after damage is done. In the late 1970s, the U.S. experienced double-digit inflation, peaking at 13.5% in 1980, forcing the Federal Reserve to raise rates and trigger recession. Currency collapse is not hypothetical. The Soviet ruble, the Argentine peso, and the Zimbabwean dollar all serve as warnings of what happens when monetary authorities print without restraint. Each collapse eroded savings, disrupted trade, and destabilized societies. Reserve currency status brings privileges but also responsibilities. It enables enormous borrowing, as the U.S. enjoyed throughout the late 20th century under the dollar's dominance. However, rising debt ratios have raised questions about sustainability and geopolitical shifts in global capital flows. The U.S. federal debt crossed $10 trillion in 2008 and has since more than tripled, making servicing interest a significant fiscal constraint. As interest payments grow, discretionary spending competes with healthcare, defense, and social safety nets. Quantitative easing became a core tool for major central banks after 2008, with the Fed's balance sheet swelling from under $1 trillion to over $8 trillion. This massive expansion in central bank money has few historical parallels outside wartime mobilization. Money printed without corresponding increases in goods and services erodes purchasing power over time, a lesson learned emphatically in early 20th century Europe. This cause and effect chain is at the heart of every inflation episode recorded in economic history. During the COVID-19 pandemic, global debt surged as governments enacted fiscal support to cushion lockdown impacts, pushing world debt above 350% of global GDP. These interventions stabilized economies temporarily but added layers of future obligation. The European debt crisis that erupted in 2010 revealed the dangers of currency unions without fiscal union, as Greece, Ireland, Portugal, and Spain struggled under sovereign debts and compact fiscal rules. Bond yields in Greece spiked above 30%, signaling outright market distrust. Quantitative tightening, or the reversal of central bank balance sheet expansion, introduces new headwinds as liquidity drains from markets previously supported by easy money. This transition can elevate volatility, tighten credit, and stress financial institutions. In every crisis, connected economies suffer first. Banking systems act as conduits where leverage amplifies shocks from households to corporations and sovereigns alike. Stress tests after 2008 revealed vulnerabilities, but could not fully anticipate future credit innovations. Private investors with access to sophisticated risk analytics position themselves ahead of tightening cycles by reducing exposure to duration and credit risk. They seek liquidity before market seize, knowing that credit dries up fastest at the onset of stress. Billionaire portfolios often include insurance-like plays such as long volatility or tail risk funds, which profit when markets swing violently. These strategies mirror the ancient practice of buying protection before storms, a documented pattern among elite capital holders. History shows that debt defaults are rarely isolated events. They transmit through trade links, banking relationships, and investor psychology. The Latin American debt crisis of the 1980s continued through 2 decades, as sovereigns struggled to regain fiscal health. Economic collapses usually consist of prolonged contractions, not momentary crashes, with recessions deepening into lost decades of output and income per capita. Japan's experience after 1991 stands as the most cited historical example of stagnation after an asset bust. The International Monetary Fund was founded in 1944 to manage balance of payments crises and provide short-term liquidity, but its prescriptions have been controversial, often enforcing austerity in debt-ridden nations. These structural adjustments have had mixed outcomes, sometimes stabilizing economics, but exacerbating social distress. Inflation expectations can become self-fulfilling. If businesses and households expect prices to rise, wages and prices adjust upward, creating inflationary spirals. Central banks fight these expectations through policy credibility, but credibility is fragile and hard-won. Bank capital regulations like Basel III were instituted to strengthen resilience after the 2008 crisis, requiring higher quality capital and better risk management. Despite these reforms, banking systems remain susceptible to liquidity stress when credit correlations spike. Currency pegs can collapse under pressure, as Thailand's 1997 abandonment of the baht peg to the dollar vividly demonstrated. Such collapses often follow speculative attacks when reserves are insufficient to defend fixed rates. Investment shifts toward private credit reflect the retreat of traditional bank lending in search of higher yields. This shift broadens the credit ecosystem, but also embeds risks outside conventional regulatory oversight. Monetary policy travels a narrow path between stimulating growth and overheating economies. Missteps can induce inflation or recession. Successful navigation requires foresight, transparency, and disciplined fiscal counterparts, attributes frequently absent under political pressure. Debt accumulation is an arithmetic constraint. When growth lags debt service, borrowing becomes a drag rather than a booster. This imbalance predates every major fiscal crisis documented since antiquity. Emerging markets often borrow in foreign currencies, exposing them to exchange rate risk, which can magnify debt burdens when domestic currencies weaken. Mexico's 1994 peso crisis illustrates how sudden currency shifts can transform manageable debts into solvency problems. Government borrowing to finance consumption rather than investment in productive capacity undermines long-term growth prospects. Chronic deficits lead to impaired credit ratings, higher yields, and diminished investor confidence. National balance sheets are analogous to household books, except nations cannot declare personal bankruptcy in the same way. They renegotiate or inflate their way out of obligations. This reality creates incentives for short-term fixes instead of sustainable policies. The shadow banking system ballooned before the 2008 crisis, creating credit outside regulated banks through securitization, repo markets, and derivatives. When Lehman Brothers collapsed, these opaque credit channels froze, revealing systemic interdependence. Some billionaires diversify across jurisdictions to hedge against localized regulatory or currency risks. This geographic spread of assets is documented in billionaire disclosures and reflects a global approach to capital preservation. Central bank independence emerged as a policy norm in the late 20th century to insulate monetary policy from political cycles. Yet, independence often erodes under crisis conditions when governments and central banks coordinate to finance deficits. The gold standard constrained governments but collapsed under the pressures of World War financing, demonstrating that monetary systems shift during extreme stress. Those shifts permanently altered the global monetary order and underscored how economic constraints shape policy choices. Throughout history, debt jubilees have occurred when debts were reset through forgiveness or default. These resets have societal consequences that reshape power, wealth distribution, and economic norms. Financial crises often lead to regulatory responses that temporarily suppress risk, only for new risk forms to emerge elsewhere. This pattern of risk migration is a documented cycle across centuries of banking history. When public debt yields rise above growth rates, the gap signals long-term sustainability problems, a concept formalized in the RDG framework pioneered by economists. Persistent divergence between yields and growth forecasts invites tightening pressures. Speculators profit from mispriced risk by positioning against complacent markets, and documented hedge fund strategies reflect these patterns before downturns. Their trades often become triumphant narratives after systemic stress unfolds. Billionaires also monitor geopolitical risk because wars, sanctions, and trade disruptions influence currency stability and credit conditions. History shows that geopolitical shocks often precipitate financial stress well before mainstream recognition. The US dollar remains the world's dominant reserve currency, but alternatives like the euro and Chinese renminbi have grown in global portfolios. Shifts in reserve allocations can influence borrowing costs and exchange rate dynamics, with real economic implications. Credit rating downgrades can trigger forced selling, as seen when Standard & Poor's downgraded U.S. debt in 2011, pushing yields higher and tightening financial conditions. These market reactions underscore how assessments of debt quality ripple through markets. Demographic trends matter too. Aging populations can strain public pension obligations and shrink productive labor, compressing growth relative to debt obligations. Japan's aging society contributed to low growth and fiscal strain after its bubble burst. In the documentary framing of economic patterns, crises are not anomalies, but systemic resets triggered by predictable imbalances. Recognizing those imbalances ahead of time is central to how sophisticated investors position capital before stress becomes visible. As global credit reaches new highs, measured relative to GDP, the historical experience suggests rising fragility and lower margins for error among policymakers. History's lessons on debt, currency, and credit contraction remain as relevant today as ever. Billionaires prepare for financial collapse not through speculation alone, but by analyzing structural imbalances that history has repeatedly confirmed. Their strategies reflect understanding, not fear, of the economic forces that shape markets. Preparing for collapse is not prognostication, but risk mitigation based on documented economic mechanics that have dictated outcomes across centuries. Understanding debt cycles, monetary policy limits, and credit expansion is essential to navigating uncertain economic terrain.